Ladies and gentlemen, Radhika Gupta, probably known in Wharton circles as the Dal Chawal chef, is a tournament-level player of the card game called Bridge and has authored a book called Mango Millionaire, whose name is inspired by a dialogue from Saif Ali Khan.
I'm Janta, the mango people.
But on the flip side, she's also one of India's youngest CEOs who has scaled Edelweiss mutual fund to where it is today.
Thank you.
Hi ma'am, how are you doing? Welcome to Power Talks by Power Up Money. I'm so excited to be seated with you here today.
No, I'm doing very well. Thank you for having me.
How's your morning?
My morning's been a bit chaotic. I think I always deal with a 3.5-year-old waking up, which is all very sweet. And then there's a rush to get out of the house. And today we lost one of the car's keys. And then my 3.5-year-old actually was the person who found the keys. And we were not believing him for half an hour, which we should have. Finally, his chosen location was right.
Wait, did he not show you the keys?
No, they were lost and we were all fighting and were like, idhar hai, udhar hai and everything. And he's like, Mama, it's here. And half an hour later, we actually decided to trust him and it was there. Lesson learned, I need to listen to him. And then, of course, it's been a crazy work day.
Okay, lovely. I hope it changes for the better, your work day.
There you go.
Yeah.
I've been schooled by a 3.5-year-old, so it can only get better.
You never stop learning.
Yeah, there you go.
Okay, so I'll actually jump to taking your view on the markets today, ma'am. You know, as you know, the last 18 months or so have been in the negative, and the war situation has made things even more unpredictable. But how are you feeling about 2026? Where do you think the Indian equities will take us?
So I think firstly, markets have seen many periods where you have 18 months of flat returns, 2-3 years of no returns, 4-5 years of no returns, and it's a very boring thing to say, but I genuinely believe, one, no one can forecast, and two, stocks are for the long term, to quote that book. Now, I think 2025 was a very challenging year for India. Before going into 2026, a combination of geopolitics, slowdown in earnings, uncertainty on tariffs. And at least pre-war, my belief was that 2026, or our belief as a house was that 2026 India would be a relative outperformer because the tariff situation kind of came out of the way.
Correct.
When you did see an earnings slowdown, the government responded with rate cuts, with direct tax cuts, with indirect tax cuts. Credit growth was starting to pick up, so all the indicators looked good. Then, of course, you've had the West Asian crisis, which is a spanner in the works, and quite frankly, nobody could predict it. I mean, I keep joking that we've created PhDs on the state of Hormuz, and last year nobody knew what the state of Hormuz, a large part of the population didn't. Oil price and energy sufficiency has always been a bit of a prick for India. So elevated crude prices above 100 is not a great thing. My hope is, however, with the crisis coming to an end, oil prices will not jump down to instantly, but maybe you'll see 1 or 2 quarters of earnings hit. For some sectors and some companies, that could be first quarter. For some companies which see input price inflation, it could be second quarter. Some of them will pass it down to the consumer. So I think the growth recovery that we had thought would start in 2026 perhaps could be deferred by 2 quarters, a bit like COVID, where you had a couple of quarters of subdued demand. But that for me doesn't change the medium term outlook on the economy. And the good news is valuations, which has been a sticking point, have now started to moderate. So that's how I would see it.
So do you think the valuations are fair now in small cap, mid cap sectors?
I think they are better than they have been in a long time. I think large cap is close to fair. Mid cap has been very resilient in terms of earnings growth. If you look at India's multiple relative to other emerging markets, and the premium that we used to trade has collapsed meaningfully. So I think, yes, from a valuation point of view, things are looking better than they have been. So I think on mid and small cap earnings, actually both mid and small cap, I do believe that earnings are not cyclical. I do believe they are structural. Now, the small cap index is a very wide index. It's a 250 stock index. So there will be bits and pieces. But for the large part, if you see, and I think the definition of mid caps and small caps also in India has changed very meaningfully. These are in many cases market leaders in their respective segments, and some of these segments are just segments of the future. I mean, I just look at a segment that I track very closely, which is capital markets, and some of the best companies in capital markets happen to be mid and small cap companies, and there is real earnings growth to speak of.
So that's the
Quite a
silver
while.
lining through
That is the silver
all of
lining, and you
this.
never have a perfect set of investment conditions, right? Sometimes macros aren't right, sometimes geopolitics aren't right, sometimes earnings aren't right, and if all of these are right, then very often valuations aren't right. So investing is about taking a decision on imperfect information or imperfect circumstances.
Got it. You also made a tweet recently, which I found to be like quite brilliant and hilarious, which is, "Dear investor, if you can't
yeah.
love me at my worst, then you won't experience me at my best.
Yes.
Cheers, equities, and Marilyn Monroe."
Yeah.
Is that your ultimate message to Indian investors today?
It is. It's actually very true for life also. But it's true. I mean, Marilyn Monroe, I guess, said it in the context of herself.
Right.
But I think it's true for individuals. It's true for relationships. It's true for careers. It's true for investing. Investing is often the most rewarding when you have the courage to invest in bad times, and certainly to ride out your portfolio in bad times. You know, I was on a flight 2 days ago, and people, of course, recognized me from public media. So the air hostesses came to me and she said, "You're that famous investing lady." I was like, "Yeah." And she's like, "You know, there's this crisis happening," and I stopped my SIP. And I said, "The only," and she wanted investment advice. And I said, "The only advice I have for you is don't go out and stop it, right? Because it's about carrying through in bad times."
You know, on one hand, I see so much maturity in Indian investors now where they understand that, you know, buy the dip and like, you know, keep investing, keep your SIPs going. And on the other hand, I see like in real life, a lot of these people actually reach out even to like, you know, us, for example. And of course, you know, you just shared the story. What do you think is the reality?
So the reality is always somewhere in the middle. In a country as large as India, you are not going to have a homogeneous base of investors. You have investors who are completely new and terrified by their first correction, because remember, at least half the mutual fund folios we have today are post-COVID folios, so they aren't seasoned. And then you have an investor base that wants to increase the size of their SIPs. And finally, if I had to put a verdict on it, in March, when we went through this entire West Asia crisis, markets were down 11-12%. Indian investors added 40,000 crores in long only kind of equity mandate. So that to me is a net maturing of the Indian investor. So you will always see all kinds of people.
Got it. So, ma'am, how are you feeling about, with AI disrupting everything, how are you feeling about Indian tech today?
So we've had a underweight to average position in tech, at least in the recent past, in all our funds. We are by no means writing off Indian tech. We think Indian tech and Indian IT services companies are very resilient companies. They are cash rich companies, they are high governance companies, and it's an industry that over the last 40 years has shown tremendous resilience. So it needs time to retool and re-gear, which is why we're waiting and watching, but we're not writing any kind of obituary. I run an organization myself that is using AI, and we do believe that while AI is very powerful, there will be someone needed to implement a lot of this AI and some of those mandates, and I think Indian companies could be the beneficiaries. So we're waiting and watching, not writing anything off, certainly for the time being.
So you think this won't really adversely impact India's growth story?
I think, no, so you asked me a question on Indian IT. I think a broader question India has to answer as a country and has to grapple with as a country is job creation, because we are at the peak of our demographic dividend, and the difference between dividend and liability is how do you employ people gainfully, and you are developing and industrializing at a time when there's so much technological prowess. So I think it's a larger question for India to answer. I think as a country, perhaps we've been seen as the anti-AI trade. We are trying to play catch up. We are trying to make a play in things like data centers, for instance, which I do believe will be a very large industry of the future. I think you are seeing a lot more action in AI startups. So yes, we've been a little bit behind.
Yeah.
Broader question we need.
We've also not caught up very well on manufacturing, right? I mean, we've been meaning to become a manufacturing superpower
So
for.
there I think we have made more progress. I think PLI, for instance, has been successful in certain sectors. The contribution of manufacturing to GDP has steadily risen. So there I think sector-wise we have made more progress.
Actually, one of the places where India has seen unprecedented growth is also Edelweiss. Because I was reading the report, just a few days ago where, you started with about 182 crores of AUM in 2011.
Yeah,
and
I
now
saw
you're
that
at
graphic, yeah.
1.7 lakh crores AUM. How does it feel? What do you think Edelweiss got right?
Oh, I think it's too early to write a great report card on us because even at the size that we are today, there is so much for us to do. I've been leading this asset management company for almost 10 years, and I'm more excited to create products and platforms and profit pools today than I was when I took over as CEO of this business. So I think it's too early to write a report card, but at core, we are a consumer business. Asset management is finally, investing is the engineering, but we are at heart a consumer business. We build products for ordinary investors. So we have to be clear about what problems we are going to solve for them, what money problems we can solve through our products. We have to be clear in the communication that we give to our investors and also our distribution partners, and we have to deliver by and large on the claims that we make. So I think that is what we have got right. Creating products that people find useful. We've been so far responsible or behind some of the most innovative first to market launches in this country, and I hope we continue to do that. I think every year or two we have something that the industry or India has never seen. So I think the consumer at the heart of it in solving consumer problems. And the second is consistency in fund delivery. I mean, you can't market a bad product, right? Finally, the consumer has to see investment returns. So very, very process oriented, consistency of returns. That's really it. It's a simple business.
How do you come up with these new products? I mean, Edelweiss has launched a lot of innovative products. Even in Gift City, for example, there has been a lot of innovation. What does it feel like to do something different and innovative when the rest of the industry is probably not doing as much?
Oh, so we get a kick. I think the reason we do what we do is we get a kick out of being innovative. I mean, nobody likes to be, at least I would not like to work for a company that is status quo and never just innovates. I think innovation is exciting. It makes people feel excited. I mean, we launched one of the first hybrid SIFs in the market. We probably are the largest individual player today in that business. It's a huge kick for the team, right? To do something that nobody else has done, even though sometimes it means that the RTA ecosystem is not ready and you have to work with the regulator and the operating platforms are not clear and you're setting standards. But for I think each and every member of that team, that gives you a kick because then you're relevant, right? I would never want to work in a company which is irrelevant to the industry. You don't have to be the largest, not necessarily, but you have to be relevant, you have to be meaningful. So I think that gives us a quick kick. We actively have a framework for innovation as a company in terms of getting consumer insights, getting distributor insights, collecting them, talking to them. We have very, very animated product committees where we tear down products and say, is this useful? Is this sensible? Will we be able to do that? So that's some of the stuff we do in-house. But we're all kicked by innovation.
Any launch that you've been particularly proud of?
Oh, I mean, many, and there are more this year. I think the whole Bharat Bond franchise, we really created a fixed income product India loved. What we did with international funds, we brought international investing early to the market. Some of the smart beta and momentum oriented funds. Recently, I think SIF has been a fantastic launch for us. And I keep getting these messages from customers. I mean, I've had people write to me saying, I've done my first pocket money in Bharat Bond, or I get a lot of the Altiva SIF investors saying, I put my retirement money, I'm so happy, March was really tough, but you guys held through. So very, very encouraging.
Got it. And do you think you've always, ma'am, encouraged, SIP investments and, Is that how you think the next set of wealth creators in India can be created through SIP investing?
So I think SIP is a way to invest, and it's a very sensible and logical way. I mean, I'm a large SIP investor. It works. It's not magic, but it works for the construct of many people's lives because many of us are salaried. We have recurring income. And if it was left to us and we had to say how much to invest every month, we'll end up spending a lot of money. I always say SIP is like TDS, right? TDS is tax deducted at source. You can't debate whether you want to pay tax because it's deducted at source. SIP is investment deducted at savings deducted at source. So it comes in before it touches your bank account, or once it comes into your bank account, it goes away, and suddenly you've built this large pool of savings. It also saves the drama of market ka kya hoga, kab dalein paise, which honestly all of us are very, very bad at. So I think it's a disciplined tool that works.
So do you not see much merit in trying to time the market?
I see no merit in it at all, and I think people are terrible at it. I think timing the market is what I call man ki shanti, and you feel very good. I remember that day that markets fell a lot because of election. I think it was June 4th. I had a little bit of money in my bank account, so I put it in mid and small cap funds. I called my husband. I said, "Yes, I put it on a down market day, and look, I put this money." And he's like, how much difference is this going to make in your portfolio? He's like, this is all man ki shanti, Radhika. So I think timing the market is the need to feel intelligent.
It makes you feel productive.
It makes you feel very good. And it really gives you a lot of man ki shanti that I did it today. But in aggregate, it doesn't make a difference.
I also wanted to ask, we've gone from having a scarcity of products to an abundance of products, right? I mean, there are global funds, there are ETFs. Even within the mainstream mutual fund categories now, there are so many schemes. Do you think it's giving more choice to people, or it is making it easier for them to in fact make mistakes?
Both. Reality is there's a lot more choice, and choice is great because some of these innovative products are very good. Some of them I really believe solve problems, but there's a lot of confusion, which is why I think two things. One, consumers have to be very thoughtful. I always say that the city of Mumbai has hundreds of restaurants. I'm sure 20 new open every week. But if you were to eat at every restaurant that opens in the city, you are going to get indigestion. So you need some framework for where you're going to eat and how you're going to choose that. I think that framework is going to come from advisors. So you actually need to have a solid financial advisor who can help you. These are all Lego pieces, right? How do you build your own building? Is a framework that you need to build ideally with an advisor.
So global funds are often positioned as a great diversification tool in Indian portfolios, right? Does an Indian investor need both gold and global exposure in their portfolio?
So I think I like the way you frame the question. Gold is in some way global exposure because gold is not mined in India, nor is it priced in Indian rupees. So it
benefits from rupee depreciation.
And it benefits from. So one of the cases for international exposure, which is rupee depreciation, is covered with gold. The case that is not covered is access to other economies. So I would say count gold as your global exposure. That's fine. Now, there are markets. India is a great market. It's one of the best performing equity markets over the last few decades. But there are a couple of other meaningful markets that you want exposure to. If you look at MSCI ACWI, which is the global index, India is 4% of that. Now, as an Indian investor, of course, there will be home bias. You are a lot more comfortable. But do you want to be 100% India? Little bit unlikely. In my view, there are at least two major markets that you should have exposure to. One, because different economies do well at different times. And secondly, there are a lot of themes that are just not present in India as an economy. So semiconductors, for instance, you just don't get a play in India. High-tech pharma research, you just don't get a play in India.
Hardly any listed companies in India that have.
The sector is just not very large in India. AI, you just don't get a play in India. So where do you get these plays? You get these plays from other markets.
So which markets do you think Indians need to diversify into?
So I want to answer this structurally because I think people are tremendously tactical, but you need US exposure. US is 60%. So if you're building a portfolio that's 20% global, at least 10 to 12% should be US. Now, it could be US tech, it could be US aggregate, it could be S&P 500 that you decide, but you need some US exposure. Then if I again come to MSCI equity, there's US, which is large, India you've already covered. The second largest economy in the world is China. So that to me is your next set of exposure, because again it's a very, very large economy. It has plays that the Indian economy doesn't have. For instance, they are market leaders in the whole EV space. They are making serious progress in AI, and they are also a very, very large consumer and tech economy. So I think these are the two big core ones, I would say. Everything else is satellite.
So US, in fact, has been a very common answer whenever I have asked this question. I never get China. Why do you think China is such an opportunity?
I think you don't get China because nobody else runs a China fund. And then there's always this patriotism angle which people bring up with these things. But this is the second largest economy in the world. It's the largest emerging market in the world. It's moved from an economy that was heavily export dependent to heavily consumption dependent, and it's still growing at 4-5% plus, which makes it one of the fastest growing major economies in the world, and in some sectors it is now a leader.
I think I've also heard you say that China and India's growth are very decoupled. So when India will do well, China may not. When China
at least the stock market is very decoupled, because I think foreign flows either pick allegiance to India or allegiance to China. China is also significantly cheaper.
What is the best way for an Indian investor today to have global exposure?
So it used to be buying local mutual funds, and unfortunately many of the limits are closed. We have a 5,000 rupee limit now on our funds. We have one fund available through GIFT, that is China, with a $5,000 minimum. We will enable more funds. So right now GIFT or buying stocks directly.
So just like you have gold in your portfolio to for downside protection. Similarly, you can also have China in your portfolio, so that when Indian equities are not doing very well, you have China to sort of like protect your capital. But GIFT has its limitation. I mean, it has a big entry barrier as well.
Well, at $5,000, I don't think so. 5 lakh rupees, you can at least start.
Are you optimistic about, the way GIFT will play out?
I'm super optimistic. I think we will have a very, very large GIFT business. It will take time for the ecosystem to develop, but both inbound for NRIs wanting to access India and outbound for Indians wanting to access overseas, I think GIFT can be very, very large.
You've also spoken about BAFs, ma'am.
I have.
And they're a smoother way to participate in equity. But if an investor enters expecting equity-like returns and debt-like safety, is that expectation not a risk in itself?
Yeah. What are you getting with a BAF? You're getting a fund that on average has 50% equity exposure. Sometimes it's 30, sometimes it's 80. The benefit of BAFs is, I mean, I'm just looking back to our BAF in COVID when markets fell 30%, the BAF fell 13-14%. Now, if your capital falls that much less, even if the recovery is less, the compounding value is higher. So I think when I go back and look at the numbers, in any long-term period, BAFs are able to capture 80 to 85% of market upside with maybe 50% of the volatility. That to me is a great trade. I don't know why this asset class is forgotten.
Can we talk about real estate?
Yeah.
You've
Although I'm not an expert, but we can talk about it.
You've spoken about, how home buying is an emotional decision.
It is.
But of course, when you're investing in a second property or a second home or something, that has to be a very practical decision. Yeah. Do you think that mutual funds can one day earn the same level of trust that real estate does? Real estate is tangible. Yeah. You can see it, you know that you own it. You don't really feel that you own mutual funds. What do you think that journey is going to look like in terms of trust earning?
I think they can earn their own kind of trust. You'll never be able to hold a NAV. You'll never be able to live in an NAV. You'll never be able to hug an NAV. You'll never be able to build a walk-in cupboard in an NAV. I mean, so I don't think we can play that game.
Right.
But if you have a 5 crore home, you can't liquidate 50 lakhs of it, and that you can do with a mutual fund. If you have any lakh home and you sell it, you can't sell it in 2 days. That you can in a mutual fund. So I think mutual funds will earn trust and are earning trust, playing their own kind of game.
Also, investing in mutual funds can enable you to buy that home.
Of course. I also think people have a slightly warped logic when they look at real estate returns. So, remember there was a news a few weeks ago or something where they said Amitabh Bachchan bought a home in the 2000s and he sold it for 3x or something now, and wow, what returns.
You keep hearing such news.
you calculate the CAGR on that, it's probably not 8%. I mean, so with real estate, people think in times, and in mutual funds, suddenly we start thinking of CAGR. So we don't migrate them and look at them on the same spreadsheet. And I really think most of the times when you do, despite my bias as an AMC CEO, mutual funds come out better. I think the greatest source of trust of mutual funds is this. It's the only, perhaps we don't market it enough, it's the only financial product in the country where you can get your money back in 2 days, no questions asked.
That's true.
You can't do it in an FD.
Right.
You can't do it in an insurance policy. You can't do it in real estate.
You often say that, and that's what you've spoken about in Mango Millionaires, you know, your book also, that investing is simple and we make it complicated. Why do you think people resist simplicity when it comes to money?
Because you resist Dal Chawal in your house also. No? You suddenly start saying, I'm rich and intelligent and now I need to go eat sushi and avocado toast because, you know, home cooked Dal Chawal is boring. And I think excitement should be sought in other parts of life, and that is not investing. So I always tell people 80-20 framework, keep 80% of your hard-earned money Dal Chawal style, 20% you want to be experimental, go be experimental. You don't even need to do that. So sometimes people tell me, oh, so what do I do with this 20? What experiments? I was like, don't do any experiments if you don't want to do any experiments. But see, I think one thing that will happen is as India evolves and as Indian capital markets evolve, the range of financial products that's going to be out there is just going to be much wider. From direct F&O exposure to real money gaming, and I'm talking financial products in a much broader sense. So your desire to experiment, do kitch, that will always be there. Now I am very pro innovation. I'm very pro new ideas. It's just that you should pick a new idea, not because it's a new car in town, but because that car is going to deliver some value to you.
And how do the goals evolve in, let's say, your 30s and 40s? I think you have a rule around that also.
I have a rule in the book.
Right.
So in your 20s, what we say is that just 10% of your post-tax income, if you can save that, even if that sounds small, it's absolutely fine because all you need is habit creation and you're smart, right? Once you see the habit working for you, you'll make sense of it. In your 30s, life starts to get serious. So we say target 30% of your post-tax income. And then in your 40s, when you also have to start thinking about retirement, we say target 50% of your post-tax income. So it's a 10-30-50 rule for your 20s, 30s and 40s.
Got it. What excites you the most about being in the mutual fund industry today?
It's a tremendously purposeful existence, which is why I'm excited about it, because you are finally enabling the financial aspirations of ordinary Indians. And I'm very fortunate that because people know me, I get to see a lot of this and I get to experience a lot of this at airports and malls and wherever I go, and people ask. And so it's actually a very, very blessed profession. If you just see it as alpha, beta, this, that, mid cap, large cap, that is one way to see it. But if you see the end purpose of what you're manufacturing and enabling, it is the financial aspirations of a lot of people. And it's a good product. At heart, I always tell my team as a CEO, I feel very proud that I'm selling a good product. I'm selling a product that I invest in myself. I'm selling a product that I recommend to my mother-in-law. I'm selling a product I recommend to my son, and I'm selling a product that I recommend to my household.
Do you make any changes to your portfolio when the markets are volatile?
Oh no, not really. I do very, very large SIPs. So I have an SIP that hits every week. So, in volatility, it's already happening. I actually lead a very, very busy life, and I've structured my personal investments in a way that they don't demand too much of my time, because I still believe my active income is going to be larger than my passive income.
If I may ask, what does your portfolio look like?
Oh, so it's very simple. I mean, I've always said this. It has two components. It's got a mutual fund component that typically ends up being 85-90%, depends on the mark to market. And then the rest is unlisted stocks. My Shark Tank companies and a lot of other small unlisted companies, that is my, I don't want to call it CSR, but that's my not Dal Chawal part of my portfolio. That's my like hakka noodle and biryani kind of
Yeah,
part
that's
of my
like street food, a little
That's like my
risky.
street food. It's super risky. It's super, super risky, but it's super fun because I enjoy dealing with these entrepreneurs. It's also a way of giving back, and so that's that. So there's all these very early stage unlisted companies, and I have a lot of them now. And then there's 85% mutual funds. That's largely mid and small cap. I have some international funds. I'll have some multi-asset funds. Of course, a large amount of exposure will be Edelweiss. So that's it. That's it. It's quite simple. I don't do anything else.
Got it. Very Dal Chawal portfolio.
Very Dal Chawal with a really exciting street food component at the
Right.
end. It's exactly what I advocate for everyone else.
Understood. Ma'am, of course, we spoke about how half the, mutual fund investors have actually come in the last few years only after COVID. They haven't seen much of like a market crash. Sure, some corrections, but I wouldn't really call it a crash, right? Any advice to them on like, how to weather through these times? Like, for example, a lot of people have also entered the market in the last 2 years. They've seen very flat to negative returns only. It's very easy to feel demotivated because you keep hearing that, you're going to make a lot of money in the equity markets. You hear from other people's experiences. And then when it's your turn, you don't experience it. There's a meme also, which is that last year when there was, the gold rally was happening, and there was people were trying to time the, investing in the gold rally, and there were memes that were coming out that it will start falling the day I invest in it.
I would say watch the memes and social media less and try to get more perspective by looking at slightly longer term data. I think the problem is that in the social media driven era that we live in, there's a lot of here and now, and there are 20 views on everything. Anyone who's been investing for some time will tell you 18 months flat is not the end of the world. I mean, we've all seen 50% down markets in a single year. So try and study and understand markets, even if you haven't experienced them, through the lens of a lot more long-term data. Try and set your time horizon to decades.
I think on your X, I had seen there was a report that Edelweiss Mutual Fund had released that for every 18 months of negative or flat performance, the way the markets perform right after that has been quite tremendous.
Of course. And that is my point. That is, again, trying to pull people back and look at long-term data. So we're looking at data of the last 20, 30 years and saying, yes, the last 18 months have been flat, but has this happened before? So it's normal. When this happens before, what happens after?
What is a good mistake that you think people should make in their journey? Like you've also said that when you're younger, of course, you're not investing too much.
Yeah.
So you can learn with, not losing too much. But what's a good mistake in your head?
I think a good mistake is starting. Yeah, starting early is a good mistake because you will make mistakes when you start early. And finally, by the way, I think in life, most mistakes are good mistakes if you don't repeat them.
That's a good way to look at it. You have also said that every journey has two components, chances that you get and the choices that you make. What has been the most defining chance that you got and the most defining choice that you made?
Choice is to move back to India. That's a great one. And chance is to run this business.
If you could give like one piece of advice to your younger self, what would it be?
I would give no advice. I get this question all the time. I would give no advice because I think women in India especially are given too much advice. There's this whole environment of log kya kahenge and samaj kya kahega. And we have too much log and samaj, right from your Poopa ji who tells you when you're 9 years old that you're not thin enough, to someone who tells you you're not smart enough, to someone who tells you you should walk more slowly at your wedding and behave demure. I would give no advice to my younger self because I got too much advice and too much unwarranted advice, and I would let myself figure it out. So if you make a few mistakes in choosing a couple of bad mutual funds, chill. It's okay. Be nice to yourself.
I think that's a great note to end this conversation on. Thank you so much, ma'am, for giving us your time.
Thank you.
Thank you.